Afternoon. My name is Christian Coles and I currently work at Macquarie Bank. I've been there for 7.5 years now. My remit there when I started was to help set up a physical gas trading business for the bank. And I'm going to talk a little bit about the wholesale markets and what I see, as it says here, what are the threats and opportunities moving forward. So I'm going to give a little bit of history, and for some of you it will be old news, but I think hopefully it will give us some perspective on the market. Very briefly touch on the credit crunch and the effect on the market, because I think that again is important to where we are now. To post the crunch, as it were, and where we are now, and as it says there, a little regulation, and then the future. But first, and I'm going to show you one slide very quickly, because I feel it's very important to advertise where you work. So this slide's going to be up very quickly, and I won't talk for too long about Macquarie. This is just a very brief overview of where Macquarie operates throughout the world, and some of the things that we do, and some of the business we're involved in. As I said, I'm not going to talk about it for too long. It's in the sticks if anyone's interested, looking at after the presentation. But we do cover most areas. In terms of the gas and power business, we're active across Europe, Northwest Europe. We've not yet pushed particularly far into Northeast Europe or Southeast Europe or even Southern Europe. We are quite active in North America, and we are expanding as much as we can at the moment, albeit in a fairly controlled manner. So that's all I'm going to say about Macquarie. And I feel I've done my duty to the bank. So a bit of history, and as I said, the reason for putting the history part in there, as a lot of you will know already, is just to try and give some perspective about where we are now and where we've come from. So in '82, the Gas and Oil Enterprise Act allowed the government to dispose of British gas assets. Access was open to the BG pipes to allow third-party suppliers to supply customers off taking over 732,000 kilowatt hours per annum, or approximately 25,000 tonnes per annum. British Gas was privatised in '86, and I'm sure most of you will remember SID. Off-Gas was formed really to regulate the market and the industry and to help to protect customers, and that was the first taste we really had of any kind of regulation in the market. 1992 saw the threshold for supplying to end users put down to 73,200 kilowatt hours per annum. And the real big changes started to happen around '96 when the Network Code was published. And during that period, the market went from a regime where for 6 months we had soft balancing, which meant that you could balance on a monthly basis. And that created a kind of a way the market traded. So balancing would happen at the end of the month. There'd be a lot of post-balance trading where traders would look to try and balance up their particular positions at the beach. We moved from soft balancing into hard landing in October 1996, and that move was into daily balancing, and the market started to really look a bit more like it does today. 1997 saw the launch of the nat gas contract on ICE futures, which was then the IPE. And again, when that particular contract launched, it was really liquid. There was hardly anything traded there at all. And it's probably interesting to know how liquid that's become certainly over the last couple of years. 98 saw the opening of the interconnector, and that, I think, certainly for the MVP, was a big game changer for the market, because all of a sudden we went from being what was effectively a UK-based market to one that all of a sudden had to start thinking about continental Europe and the effect that supply and demand would have on continental Europe. And it certainly, I think, changed the way that people thought about positions, about how they put trades on, and about really what was happening. And it started to open the market to a more global market. In 1999, Off-Gas and Offer merged to become Ofgem, and we took another step forward into having some kind of regulation in the market that wasn't there historically. So if I can, I'd like just to fast forward to the credit crunch, which is probably still fresh in most people's mind, but in Feb 2008, Northern Rock was nationalised after it failed to find a buyer for its business. They could no longer fund their activities, and their business model was based on lending long and borrowing short. And effectively, the market lost confidence in them, so they could no longer fund themselves. 2008, March, Bear Stearns were bought by JP Morgan. The share price when they were bought was around about $2 a share, and at one stage in the previous year they'd been up over $130 a share, so it was a massive drop in value for Bear Stearns. JP Morgan recently dropped the Bear Stearns name completely from their business. From a trading perspective, we saw a massive drop in liquidity across all the markets. The NBP market, it felt like it died. I don't think it did, but it felt like everything had disappeared. One of the big problems was that people no longer trusted the balance sheets of other organisations, and the banks were particularly hard hit because no one really had a good faith in, does the balance sheet that we're seeing actually represent the financial health of the organisation we're trading with? Will they still be here next year? Are there issues surrounding the way they've stated their accounts? All these things came to people's mind. All of a sudden, the market starts to grind pretty much to a halt. As I said, banks were, I guess, the worst hit, but other organisations were as well. And there was a general air of suspicion across the market, particularly across that summer period. 2008, September 2008, Lehman's filed for Chapter 11. They were again no longer able to fund their business moving forward. Bit of a chart, and this is taken from front-month ICE contract. The blue spikes are the day-by-day traded volumes. The yellow line is a rolling 20-day average, just to try and smooth it out a bit. But as you can see, there is a part where through the summer of 2008, liquidity disappears or starts to fall away from the market. But as a general trend, liquidity, although it bounces around, and it bounces around for all sorts of reasons, but as a general trend, liquidity is picking up. And I don't have it here, but if you look at the OTC traded volumes as well, they're A, much bigger, and B, the trend is there as well. The trend does continue upwards in terms of liquidity. So what's been the effect of the credit crunch? Well, we had seen a fall in liquidity, albeit a temporary fall. That was more so in the over-the-counter markets, and the future markets, whilst they were affected, weren't affected as much. And part of the reason for that was that where people were afraid to trade OTC, they were happier to trade in futures markets because obviously the credit risk is significantly reduced. General risk appetite decreased. Effectively, from a pure trading perspective, the amount of capital you were given to trade with decreased. And that's a function of all sorts of reasons. A, because liquidity decreases, banks get nervous about levels of risk that gets put onto the books, and other trading organisations get nervous about what risk is put onto the books. So general appetite for risk decreased, position limits were smaller, rationale for putting trades onto books or for actually transacting any type of trade needed to be stronger. And as I said, that wasn't, whilst it seemed to be more prevalent in the banks, it wasn't just the banks that were affected, it was across all of all organisations. And I think that we saw just a retracement in people's willingness to get involved in markets. We also saw a disappearance of a number of players permanently from the market, which again decreases the number of players in the pool, if you like. Although I don't think that was to the extent that we saw in 2001 and 2002 when Enron and TXU went bankrupt, and we saw a lot of the American trading houses that had come over to Europe to get involved in the market suddenly disappear. And I guess the big thing is increased regulation, and that's not just across the gas and power markets, but it's across all markets. Everyone seems to be focusing on areas where they can tighten up and make things not necessarily more difficult, but more stringent and really give, I guess, comfort to the general public to a certain extent that people are doing things. Historically, physical markets have come off pretty lightly in terms of regulation. Certainly the commodities markets haven't had too much of an issue. European gas markets seem to have been fairly largely overlooked historically by regulators. Of course we had Ofgem, but they kind of know the market. That's their sole task, is to look at that specific market. The FSA is involved, but really more to a financial perspective than a physical perspective. That's no longer the case, and that's a direct fallout, I think, from the credit crunch, and I guess the opinions not only of politicians but the general wider opinion about traded markets. New regulation now cuts across everywhere. It's not just banks, who I think probably were more heavily regulated, but across trading houses, across utilities, and across producers. So what are they? Well, MiFID and MiFID II. MiFID was really the main aim of MiFID was to try and harmonise regulation across the EU states. Came into effect in November 2007, and really MiFID would have been there prior to the credit crunch anyway. So MiFID would have happened. It wasn't really part of the credit crunch. It wasn't as a result of the credit crunch. It's something that was happening anyway. It covers all tradable financial products, and that's the key to MiFID. It's financial products, but it does include commodity and other derivatives such as freight, carbon. Key aspects of it were authorization, regulation and passporting, client categorization into different levels of clients, if you like. So very expert clients right the way down to retail clients. How client orders are handled, transparency and what is shown to a client before you actually trade with them, and then post-trade transparency, so the client can understand what they've done in light of what the market's doing. And also best execution, and that just deals with how you take a customer order versus your own internal trading. It had an effect of increasing overall costs, but the overall effect to the European gas market was limited, and if it stayed just as MiFID, it would have been limited overall moving forward. I don't think there really would have been a massive effect to European gas and power markets. I'm not sure that the same could be said for MiFID II, which is a completely different ballgame and a bit of a game changer for us. It's got much wider reaching remit, and it covers broker-dealers, investment banks, corporate houses. It covers market infrastructure providers such as Bloomberg, Trayport, Reuters. It covers buy-side firms such as asset managers and hedge funds. It covers all energy companies and other commodity players. And really it's there to supposedly address two broad areas. A, the conduct of business rules for intermediaries providing investment services, and the effective and safe operation of financial markets. And the second part there is quite a wide touching area. The changes are supposed to provide a level playing ground, so everyone's supposed to be equal, which is a good thing. It's also supposed to try and adapt the regulations to take into account technology. And just touching on the technology part, one of the things that was recently highlighted as part of MiFID was things like the high frequency trading, where they want to try and increase the amount of time that bids and offers are placed on screens for. So that's just one area where technology is changing and the regulation is trying to keep up with it. They want to try and provide for transparency to investors and regulators across a wider range of markets. And I guess the key thing for gas and power markets in Europe is the stronger supervision of commodity derivative markets. And there seems to be an aim to strengthen the restrictions on commodity price manipulation. I've touched on the high frequency trading very briefly. remit, which is designed to introduce a European-wide framework, and it looks at and tries to define market abuse and what it is, market manipulation, attempted market manipulation, and insider trading inside the wholesale energy markets. And that's something we hadn't had historically. It introduces explicit prohibitions on market manipulation. It also really tries to establish the framework on how you monitor those, how you deter and how you detect that manipulation, and includes a whole raft of new reporting framework that, again, we haven't historically seen in the energy markets. Participants in the commodity markets will need to report information, again, that we haven't had to do historically to facilitate the monitoring of transactions, and includes things like the capacity and use of facilities for production of electricity and natural gas, storage and consumption of electricity and natural gas. Step too far. And again, we hadn't seen those historically. And actually, from a pure trading perspective, it's actually a reasonably good thing. We have a lot more information about what's going on. So we don't get to halfway through the day and wondering why the market's going through the roof, because we can now say, okay, well actually we know that because X, Y, Z field switched off, or production's been moved from here to there, and that affects this market and that affects that. So there's a lot more information there, and actually it's probably a good thing because it helps the market remain less volatile and more stable, but also means that people are probably likely to have more confidence. So very quickly, what's the future of the market? Is there cause to be concerned? I'd say yes and no. Yes, because we are seeing we're seeing a time where there are regulations coming into the market that I don't necessarily believe should be there and aren't necessarily helpful. That's not to say that all regulation is bad, but it needs to, I think, to be it needs to be proportionate. It needs to be effective in the markets it's trying to regulate. Will there be an impact on liquidity and the ability to do business? Yes, I think there will be an impact. The problem with things like MiFID is they're trying to push, they're trying to standardise trading and push it towards an environment where everything's cleared, or where you can clear trades, they are cleared. And all it does is start to push up costs. When you start to push up costs, people are less likely to trade, and if people are less likely to trade, you lose liquidity. If you lose liquidity, then volatility increases, which just increases the cost for everybody. The other, I guess, big issue as well is, and we've seen it a little bit over the last couple of months, is that liquidity starts to move further down towards the front end of the curve. So people are less interested in taking long-term positions on the back end of the curve. So it makes it more difficult for utilities to hedge, makes it more difficult for producers to hedge further out in the curve, because all the price action, all the trading action happens on the front end of the curve. And a lot of that is to do with the cost of putting positions on and holding them. And if you're holding a trade for a long time, it costs you more money. I do think there is a chance that we will move back towards a more oil indexed type environment where gas and sales purchase agreements are made on linked into oil contracts, if we end up in an environment where the costs associated with trading become too great. Because it's just easier. If you're a producer and you want to sell your gas, rather than going into a market where it's expensive to trade, if you can sell it against an oil formula where you kind of have a good understanding of the oil market, why not do that? And if you're buying gas, you're a utility and you're buying gas, why not go back to the old way of doing it? Because that's what happened historically when there was no market. And if we're moving back into a world where liquidity reduces, that may well be the upshot. Overall, I think there is a chance or a potential for there to be higher costs. Will there be opportunities lost? Potentially. again, I think we've seen, and it's important to see that we've moved a long way in terms of the market. Certainly over the last 15, 20 years, the liquidity in the market has increased massively, and we now have a market that attracts all sorts of players. And I think that's a great thing. It would be a shame to move backwards. So there is a chance that opportunities get lost because players just don't get involved when there's no liquidity. There could be some opportunities though. And is this a chance, with the right regulation, for the European gas and power markets to become more accessible? And potentially there is, and although it could be argued that it's a two-edged sword. Firstly, if we have a more structured market where the products that are traded are structured and everyone knows what they are, people know when settlements are, there's less negotiation around them, you may see more players coming to the market that wouldn't necessarily come to the market, more financial players. You may see a lot more hedge funds coming to the market, and we already see them now, and that could be a good thing. However, their interest doesn't necessarily lie in the underlying workings of the market. They don't necessarily have an interest in the underlying workings of the market. They have an interest in markets that move around and markets where they can make money. They don't have a vested interest. And I think that's, as I said, a double-edged sword. Whilst they maybe would provide liquidity, it's difficult to say that they would be there long term and whether that liquidity would stay. And as we've seen from other markets, they do have the ability to move things around and make markets more volatile. So overall, I guess it's a question that I can't really answer in terms of what the future looks like. And if I did answer it, I probably would be on a beach somewhere. I think that we're at a time now where we are seeing a lot of regulation come to the market that I think as a group of people we probably want to push back on a bit. I think there are some good things to come out of regulation. I think REMIT's probably a reasonably good example of where we've seen, or we hopefully will see, good things happen. I think it's great that we've seen a lot more information coming to market than we ever have done historically. I think it opens it up as a place where liquidity can grow, where people can feel more confident about what's happening. I guess the issue I have with MiFID 2 is it's trying to, and I feel like it's trying to do things that we don't necessarily need, and part of me thinks there's an element of point scoring from a political agenda that doesn't actually have a lot to do with making the gas and power markets a better place or a more effective and safe place to be, but actually is more about being there and saying we're doing something, whether that's the right thing or the wrong thing. So moving forward, I would hope that we can push back and say, do you know what, this works really well for us, but this element doesn't. But overall, I'm bullish the market. And bullish, I don't mean I think prices are necessarily going to go up. I'm bullish in the respect that we've come a long way in the last 20 years, and I think there's a lot of change is going to happen. And I guess from a trading perspective, I've certainly seen the number of players grow in the market, the number of people getting involved in the market, the liquidity in the market, all grow massively. And it's not a linear curve. For me, it's exponential. And I think moving forward, it will be a good place to be. But as I said, I think for me, it's about pushing back and saying this works for us and this doesn't, and trying to change what we can. So that's, I guess that's what I wanted to try and get across to everybody. If there are any questions, I'd be happy to.
We'll do those later.
We'll do those later.
Thank you very much, Chris.